We're looking at a waste management company that's already SBA pre-qualified, and this is a Transworld listing. As I mentioned before, I love Transworld listings. They're generally, I don't know how they onboard their brokers or something. They're generally taught well how to make deals work that can sell. So they're asking three times, a little bit over on what their cash flow or EBITDA is. Obviously, this isn't a hard number. This is always subject to due diligence. But reasonable price point for a very recession-proof business. Waste management, dumpsters, trash removal, all of that is highly, highly recession resistant. They're good businesses. This one is over 20 years old in the Metro DC area and family owned, so it's always good. At the end of the day, it's a solid business. For whatever reason, though, there's some discrepancy, the biggest one being established versus established since. So maybe there are multiple locations within the family. Don't know if things to be discovered as you go. But the strong piece of all of this is right here. 80% of business coming from existing customers. That's significant. The other bit is that they're a 24% margin business. That's very solid considering you're basically arbitraging people, capital, and time. So it's very well run. And they're definitely not off when they call it a cash flow business. But because this is family owned, 40 years in business, it seems like they're looking for the right structure for long-term ongoing rather than just, pulling as much cash out of it as possible. Because realistically, they could have just said, hey, we're making $500,000. We want 2.5 or $3 million because it's been around for 40 years and it's probably been hyper consistent. So, there's good potential here. It seems like the owner wants a good transition. And at the end of the day, there's a lot of juice for the squeeze. That's also why I like the Transworld listing, because usually they dive into that. Where is the juice for the squeeze? Well, it comes down to the digital presence, to the marketing, to potential new opportunity in the recycling space. So, overall, seems like a decent business. 11 employees, not bad for the 1.9 in revenue. So it's run relatively lean. Obviously, again, subject to as you go through the due diligence of it. And they are pretty much correct. The competition in this space is typically large firms. It's franchises, it's large companies that have government contracts, things like that. So, it's an interesting subsegment that they've carved out here. The only thing, obviously, the biggest flag for me is this, 4 weeks of training when it's a business that's been around for 40 years. Either that tells me that this is an absentee owner, which is good. Obviously you have to review that with the numbers. Like I say, look at static numbers that maybe have dropped. That's a good sign of an absentee owner where there's more juice to come in and squeeze, or it alludes to something else going on and they don't care how the business is taken over. So, it's one of those two things you got to determine. The only somewhat red flag for me, and this is something that usually is not seen in Transworld listings, the other red flag is this: proof of funds required up front. This isn't SBA business, right? It's 10% down or 10% from the seller finance or otherwise. This is a stupid thing to add into your listing, because reality is for 10%, right? 100 grand, it should make no difference that the owner is footing 100 grand, or no difference that an investor is going to come in and foot 100 grand. It's very easy to find an investor for 100 grand. So this is just stupidity. This is probably, maybe it's a new broker to Transworld. I don't know. This is just stupidity. Amar, whatever your name is, if you're watching, this is stupid. Don't put stuff like this in your listing. It puts a bad taste on the business right off the bat. Now I know it's probably there to kick out tire kickers because it's a smaller business. This isn't, $1 million in profit where you're attracting, higher quality buyers, but this is just stupid thing to add. So that said, outside of that, it's a good looking business. It's one that we came across when I was looking for one of our partners. And honestly, it's a business that I'd like one of our partners to do, but we don't have someone in this area. But when we look at the numbers here, let's take a look here. Listing scenario versus AIM scenario, you're not going to notice a bunch of difference. The biggest thing I would probably do is just try and kick some more seller finance out of it. You could try and kick this down to a 3 times, but the thing is, you're going to service your debt in a crazy rate anyways, because they are quite solid. So it'll come down to obviously making sure this cash flow number is accurate. If it is, they're asking multiples not too far off. Maybe either try and get this down to 1.3-ish, where you're at a 3 times multiple, or kick up the seller finance like I did here. either one. Seller finance, really, when you look at it, it's the closest thing to free cash. So even if you have to kick that up, but you're not kicking down the price, that's fine. Like you're still ending up ahead in either scenario. But on a typical term, you're cash flowing 2 times plus. I mean, it's solid, right? Net cash flow 200,000. If you take it as is, you put your 10% down. You wouldn't really want an investor here because they're going to take a nice chunk out of that. But if you're doing seller finance, you can get your 20-25%, 275,000 a year. It's not a bad cash flow. And if it's not owner absentee, there's some skin in the game there to take or some meat left on the bone there to bring a GM. You're going to be tight. Like you're maybe only going to net yourself 50, 100 grand a year after all is said and done, which still isn't bad, right? For an absentee business, you don't need to worry about it's consistent, it's standard and operating procedure. You're not going to be in a bad scenario there. But if you're looking to come in and operate and be more hands-on, this is solid. The size of business makes sense. I mean, realistically, if you're looking absentee, this is a borderline level of where you should be looking at anyways, unless you're okay with lower returns, right? The 50 grand, 100 grand, whatever it is a year. And if you're doing that and then you're footing your own bill for the equity in, a 50 grand return on 150 is 30% a year. Nothing wrong with that. So overall, decent looking. I mean, the biggest thing, like I said, is obviously hit those flags and understand why. And then the other is just come back in here and try and get to 20-25% seller finance, and you're in good shape. Or keep the 10 and cut this down to 1.3, get a 3 times multiple, and you're in good shape on a good cash flowing business. And it's non-franchise, at least from my understanding, based on the listing, which is good. That means they've been solid in terms of building up that revenue. So there's good value to be had here if you can get it to a next level, meaning getting it over 4, 5, 10 years to $1 million in cash flow. You can get a significant arbitrage on these types of businesses. There are private equity firms and family offices that buy into the space for the right type of business, and they do pay high multiples because this is real recession resistant stuff. So by all means, if you have questions, drop them down below. If you're in the Facebook group, you'll also get the listing to this if it's of interest. If you're not in the Facebook group, there is a link somewhere on the YouTube channel to get there, and we'll see you in the next deal.